Welcome back to Market on Close. Joining me for the big picture discussion on day two of the reaction to yesterday's cut, Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research, and Nate Peterson, Director of Derivatives Analysis at Schwab's Center for Financial Research. Kathy, thinking about bonds, firstly, to see yields continuing to creep higher, a little bit of pushback, but seems like bond sellers were able to make a stand today. What does that tell you?
Well, I think a lot of it has to do with positioning on the curve. So what we're seeing is that steepening of the yield curve as short-term rates come down in anticipation of further Fed rate cuts and long-term rates going to creep higher. And I think it's all about positioning, having gone into the meeting with a lot of uncertainty about 25 versus 50, et cetera. And now the market is just progressing like, well, the Fed's going to get us a soft landing, so here we are. A more normal yield curve. If they're recalibrating policy, then or normalizing policy, we're going back to a normal yield curve.
And that can happen a couple different ways. Seems like today some selling to get us there along the curve. The 2 years put in their low a couple days back. So does that suggest that the 50 is effective, Kathy? Should we read that as the market saying, hey, this is going to be good for the economy?
I think so. I think moving fast out of the box to prevent the economy from slipping into recession, or at least avoiding some sort of economic problem, is what we're seeing in the bond market. Keep in mind, these are pretty small moves, all things considered. We're not seeing the kind of fun and activity that you're seeing over in the equity market.
Let's talk about that, Nate. Some action as Russell up 2% off the highs, but still a really good day, when that's kind of the only fade that happened in the session, that we just lost a little bit of the extreme froth off the top. It seems like a win, big one.
Certainly. If you get the Russell to go make a new high, a new 2-year high, I think that would be conducive for the bulls. I mean, we're seeing a cyclical tilt, as you'd imagine, to today's price action. And, essentially, with the market, above its prior resistance there on the S&P, fresh all-time highs, the message is, yes, we're at a forward PE of 21, but we can justify a higher multiple. We could do multiple expansion potentially because of where the Fed stands and, what they have planned in the next 18 months or so. It's not like I don't think that, the consumer or the economy is going to get reignited because of what the Fed did. In fact, because that we know that, the Fed has 50 more for this year, 100, and then another 50 in 2026, that if lower rates are, implied, and that the consumer is anticipating that, why go out there and get that car loan now? Maybe I'll wait till Q1 of next year. So you might see some of that comes into play. But I think on the bull side, given that valuation, what you'd like to see is a lot of those earning estimates, the earnings growth that's out there currently, to remain intact. Right now, FactSet has, I think, 15.4% earnings growth for 2025. They started Q3 at 7.9%, and not unusually, they're now down to 4.4%. So I really think if you want to get a push to a 22 or a 23-ish type of a forward PE on the S&P 500, it's going to come back to that earnings growth and how those estimates fluctuate.
That's where trying to figure out what the economy and its trajectory are going to be, of course, is so important here, to try and figure out if earnings are going to pick up, because those expectations have dwindled. I mean, we're ramping up on pure valuation right now, so the earnings are going to have to kick in. I mean, that's basically what's happening, right? This is just pure PE expansion in the last 24 hours.
It is, and then you also have the AI kind of question mark in terms of productivity, or in terms of, how much growth we can get out of tech going forward. I know Dan Ives is a big bull, and I know he's been on your show a lot, Oliver. He still believes it's 9 p.m. at the AI party and it's going to 4 a.m. I get it. So if that does come into the scenes, that it actually manifests within technology outside of the chip space, then yeah, that can help with the justification of a higher multiple, of course.
Okay. Kathy, do you see froth and credit, junk bonds pretty active today? High yield stuff pretty active?
Well, spreads are low. They're very tight. They have been for a really long time. But having said that, if the economy performs well, the capital markets are open, these companies have managed to continue to roll along. Certainly the financing needs for the lower credit quality companies will improve with this rate cut. They're the ones who have more of the floating rate debt. They have more of the stress in terms of the tightness in financing availability. So the idea that we got a 50 basis point cut should be good for lower credit quality relative to higher credit quality.
And generally for the trajectory for bonds, Kathy, does it seem like the risk of upside yields is limited now, or does this really have like potential to ignite inflationary forces? Is it silly to talk about that at this point if the data has been telling us more slowdown?
I think you're way too early on that one,
Okay.
Oliver. We have to wait for the cycle to play out before we worry about a rebound in inflation coming from the demand side. So the reason they're cutting rates is because inflation's come down and demand looks softer because of the weakness in the labor market. So we have to get to the other side of the cycle before we worry about demand picking up and driving inflation higher.
All right, nice. Good way to end the trading session. Back to our conversation with Jim Carson at the top of the show. He was talking about yields moving higher and inflation creeping back in, but let's take it one cycle at a time. I like the counterpoint, Kathy. Thanks. Nate Peterson, Kathy Jones.